The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box. Here are your headlines today. Volkswagen prepares for a showdown with workers and unions as it weighs up factory closures in Germany for the first time, with CEO Oliver Blume saying the automaker must act decisively. Brazil's Supreme Court backs a ban on Elon Musk's X, while the country's telecoms regulator threatens Starlink with sanctions as the fight over free speech goes on.
The US President Joe Biden accusing the Israeli Prime Minister Benjamin Netanyahu of not doing enough to secure a ceasefire with Hamas as the UK suspends some weapon exports to Tel Aviv. And France's political crisis approaches its 60th day as President Macron fails to pick a new Prime Minister, with a key budget deadline looming. A very good morning to you all. Good morning, Karen. It was to sum up in technical terms, it was a drifty kind of day without direction for the markets yesterday. There was one notable piece of news out of Europe, and then obviously that carried on the US where we had no trade. This is where I think the week really starts getting excited as well, because we've got 4 days of pivotal data, at least 4 snapshots on the US economy that I'm fascinated in the labour market alone. I think this is when it starts getting interest. Bit of beige book as well thrown in there as well. What is great is we've got a couple of top Goldman Sachs commentators, including Jan Hatzius on later on as well. I think we're going to get a really good gauge on where the US is going throughout the show.
Price for perfection too when it comes to markets, where we had the big recovery that's taken place and expectations. There are rate cuts coming. Look at the dollar moves, a big move lower over the month of August. So if we do get some sort of change in the data, any sort of snap back in terms of the dollar trade, also on markets in terms of the equities trade wobbling, because let's face it, everybody's all in now at this stage when it comes to stocks. There's been a lot of upward movement and there's a lot of enthusiasm for stocks. Yeah,
I think you're right. I think we had, look, September and October, historically, oscillating months where it pays to own a little bit of vol after the summer recess, so to speak. But the summer recess was stunningly exciting on your watch as well. And then, as I say, by the time I got in, it was all back to normal. We're back to the same kind of levels we were at the start of the month. Year-to-date gains, pretty solid across the board. Rotation in evidence a bit, but my goodness me, what great gains the IT sector's already had this year to give back a little bit.
It's funny, we keep talking about the data and what's happening with the Fed, but then in the backdrop, there is this looming election. And a lot of the commentators over the course of the last number of weeks keep talking about the risk around the US election. Yeah. So we just get past September, we may get a rate cut, but on the horizon, looming very large, sees to be this political story which could have consequences.
Can you imagine if we get a government in the United States that's going to outspend its revenues after the inauguration early next year? I mean, can you imagine if what the CBO, Congressional Budget Office, will say? Can you imagine what the deficit looks like if we get a candidate who becomes president who outspends what they've got in the Treasury? Oh yeah, it'll be the same as every other president we've had for the last 20 years. Fact, I'm afraid. Okay, let's move on to a big European story. Volkswagen is considering closing plants in Germany for the first time. Wow. Saying it's taking steps to future-proof the company. It comes as European car makers face growing pressure from Asian rivals. The announcement came under fire from unions, with the Works Council promising fierce resistance to the plans. And that, Annetta, who's hot-footed it from Dresden as well. And by the way, fabulous coverage of the elections yesterday. That, Annetta, is the problem, because the fact of the matter is, this is a company, and I will quote a Forbes article from earlier this year. Volkswagen is the archetypal legacy automaker. Flabby, slow-moving, and valued as if it was going out of business. That's the street columnist Stephen Wilmot being quoted in Forbes earlier this year. One might argue about the content of that comment, but there is a large constituency of people out there who believe it just hasn't revolutionised itself to be fit for purpose for the 21st century, Annetta.
Yes, I totally agree with you. And on top of that comes the ownership structure, which is often criticized by analysts as well. And this ownership structure is really relevant in that story now as well, because Lower Saxony obviously has 2 seats in the supervisory board, plus, of course, the Labour side. And that they will also push for no planned closure, also for no redundancies, because obviously it's not good for politicians to have massive layoffs at one of their biggest companies in the country. So it will not be easy for the management team to actually slash costs. So the plan is to slash 10 billion by 2026 and achieve a return on sales at the core brand at 6.3%. Currently, that return level sits at 2.3. So the gap between now and 2026 is too big. That's what the management and CEO Blume is currently saying, and there needs more. There needs to come more than just slashing costs. So what we look at least that's reported, and that's what the Labour Council has floated, they could shut down a factory in Dresden, the city I just came from, and also a site in Osnabrück, which is in Lower Saxony, could be a potential target for closures. Next to the planned closures comes also the fact that for the first time since 1994, the job guarantee will be cancelled, at least for parts of the workforce. Obviously, that's not that this job guarantee is no longer possible if you want to close plants as well. So I guess this story will be very political, because already by now the trade unions, IG Metall, is stepping out and saying they don't care about the yield level at Volkswagen, they care about jobs. And Volkswagen is not here to achieve a certain yield level, but they're here to have people employed. So that's the narrative currently. Of course, if they go ahead and they push against the trade unions, this will be another big blow to Scholz's government, because clearly what they're saying between the lines is also about Germany as a place to do business. It's about energy costs. It's about how friendly Germany is in terms of regulation. And on top of that comes the fierce competition from the Chinese and Asian car makers, which of course is the biggest problem for Volkswagen among the German car makers, because they are operating in that mass market the Chinese and others are targeting as well. So I guess it will be a very interesting story, which we of course focus when it develops. On Wednesday, the management is set to address the workforce, and also the supervisory board meeting is taking place this week. Probably towards the end of the week, we know a little bit more.
Annette, thank you very much for that. We're just looking at the share price in action, and don't forget the stock down about a third, lost about a third of its value in the last 5 years. So that is telling you a story in reverse. When you've got huge change in the industry, you'd think there would be profits up for grabs. You've got a whole heap of new rivals entering the mix. So arguably they see fresh business. This is a company that has been the beneficiary of a truckload of stimulus, energy costs, the support that you've seen very quickly come into the mix, the rebuilding on the back of COVID. I mean, this is a very big German company, and you would argue then potentially, is there too much stimulus that is not helping companies like this, allowed them to become flabby and uncompetitive? If they'd had normal market principles in play, would they have had to make very sharp decisions, putting the company on the right pathway
I could talk to you about this for about the next hour, and I'm tempted to. We've got some great guests later. Because they're being asked to do something that actually the governments around this world, the different states are trying to persuade the private sector to do without enough stimulus, actually. I'll say, because like you build railways without government support, without actually building the infrastructure. I mean, this is a sector that needs a stunning amount of infrastructure. And what have they done? The automakers have built expensive products that are not fit for purpose. We all know that a lot of EVs out there are beta versions of what they promise they're going to be as well. The mileage is rubbish on a lot of these vehicles as well. The infrastructure is rubbish on a lot of these vehicles as well. And you've got Volkswagen. Volkswagen is typical of companies in this sector. It doesn't want the Chinese tariffs. because it's worried about what's going to happen to its operations in China, where it does get, some real stimulus in order to build factories out there. It makes a large amount of its EVs and vehicles out there, but it doesn't have tariffs because it's worried about what's going to happen in China. And yet, without tariffs, it's not got a competitive product in Europe as well. It is typical of what's going on.
Well,
and with all due respect to the unions out there, and I don't want to pick a fight with anyone, but come on, you lot. You don't. If Annetta's accurate in what she just said, and I have no reason to doubt she's not, you don't want yields. You just want jobs. Guess what? This is a situation where you don't get any jobs if companies don't make money. If they haven't got a return on capital, then you don't make money and then you don't have jobs. You kind of have to have a bit of a yield on this one, unions, if that's what you're saying. And I'll go back to the original point. This is a company that is priced for disaster. It's 3 times forward it trades on. Three times
to
forward.
my point around normal market principles here, the unions too dominant. The inability for the company to take the sort of decisions it needs to right-size its workforce. If you think about the industry, where are the profits at this point? It's not in a mass market car, and that is obvious from the fact that Tesla will not go there. It will not go after a mass market EV. What happened to the old market principles of economies of scale? And typically a mass market car should be where the profitability is, because you get the cheapest product on the market, you get the most volume in. That is not what Tesla is doing. For instance, its latest decision around a 6-seater car. This is something that's now something that is in the works in China. This is a very large model. So typically you think that would be one of the later models to come to market after you've conquered mass market. So it's very strange how the EV market is completely skewed away from typical mass market principles. So my point, too much stimulus, a lack of competition, pure competition in its original form.
Well, the problem with that pure competition is the fact that the guys who were making 20% plus margins, i.e. the Teslas of this world, aren't anymore. And depending on which measure you use, they're making between 17 and 13%. Again, there's different measures out there. So they are scything aggressively to get market share as well, which is destroying the business model. The whole EV revolution was predicated on for these European and other mainstream US players. Look what Ford's doing, really struggling, cutting back on production. Look what every other producer is doing, struggling. And I hear what you're saying about stimulus and market principles, but if you're building something that's completely revolutionary, that relies on infrastructure, it's like saying to Ferdinand Piëch in 1938 or whatever, 1939. I mean, again, I don't want to bring out a terrible period of history, and the company's got its legacy issues with that as well. But it's like saying, can you build us a Volkswagen without an autobahn? Without the roads, you're not going to have a successful car. And so it's spin forward to 2024. If you don't provide the infrastructure and you don't provide a cheap enough product, then who's going to buy this stuff?
Well, arguably also, I mean, where is it coming from in terms of the stimulus? The Chinese. So there's been a huge amount of stimulus that's been poured into the semiconductor sector, into EVs, into battery capacity in China. And arguably that has made a huge difference for the way the West
then it's goodbye to European manufacturing if we let them have a clear road to
Yeah, so I think if you look at the situation around all the automakers, they're all struggling because the root cause of the problem is China. The fact they used to get a huge amount of profits from the Chinese market, and that has started to be taken away from some of these companies.
The problem that actually European governments and the European Commission isn't backing its manufacturers and isn't actually creating the conditionality for them to prosper. I don't know. Anyway, we've got to move. We've got a brilliant guest in the wings.
The return to trade stateside also kicks off a series of key data prints due this week, all of which will feed into what's expected to be the Fed's first rate cut in more than 4 years later this month. Now, manufacturing is expected to have contracted in August, while we'll get jolts and trade data too. Thursday sees more jobs data, but Friday's the big day with the closely watched NFP, that's non-farm payrolls print.
Oh, it's me, is it? Joe DeGrosso joins us now, who is Chairman and CEO of Access Capital. Joe, thanks for bearing with us as well as we just shooted a few comments out about the ultimate. I'll tell you what, though, why don't you... I know you're here to talk about economics. I know you're here to talk about the Fed and what have you. Any word about the auto industry in the US and how it can compete at the moment and what its struggles are?
Well, it's interesting. I heard your last comments about Tesla. I think Tesla is going to have big problems. I think they're going to face, extraordinary competition from here going forward. There's margin compression. You look at the multiple on Tesla trading at 60 times earnings. I don't know. When I look at the big opportunities in the market, Tesla does not make the short list.
Joe, would you say the same thing about some of the other big automakers, that they are facing the same challenge? If you look at the Chinese market, it used to be a cash cow for them. It's not anymore. They're facing a waning demand from new adoption in some of the traditional markets, the United States and Europe. For some of the automakers, is it a sell all round?
Yeah, I think that's right. If I had to go long one side of the industry and short the other, I'd probably short Tesla and go long Ford and GM. But it's not a sector I'm particularly excited about, to be honest with you.
I'm with you. I've been looking at the auto sector my entire career, and for a large portion of that, it has traded at low single-digit price earnings, and to which people have said to me, look at the value. Look at GM trade on 5 times. Look at Volkswagen trading on 3 times. I'm like, yeah, where do you think it's going? Anyway, Joe, look, we better move back on to what we booked you on for as well. Huge week of US jobs data as well. Ironically, I'm as excited about the other jobs data, the ADP, the initial jobless claims, the JOLTS, as I am about payroll, because I'm just worried the payroll is, for want of a better word, a random number generator.
Yeah, I think you're right. But, look, the bottom line is that the Fed is in a position where they, in my view, have no choice but to lower rates come to the 17th or 18th of September. They only get one other chance, no other chances prior to the November 5th election. So this is their last chance to move on rates. So I think it's inevitable that we see a move. We're just debating whether it's a quarter point or a half point. I personally think it's going to be a quarter point. Looking out at the 2-year forward curve on SOFR, I think it's way too aggressive. I'm very concerned about inflation longer term. But if the question is what's going to happen in the short term, I think it's inevitable we see a quarter point rate cut come the next Federal Open Markets Committee meeting.
Joe, can we get to how safe these markets are and whether you want to stay invested, even if we are going into a cutting cycle? Because it felt as though everyone rushed out of the water with the market event a couple of weeks ago. They had a quick look to see if they could see any sharks in there. They couldn't see anything, hopped back in. Now everybody's suddenly bullish on the stock market again.
Yeah, it's very interesting. You had certainly there was understandable bullishness when it looked like former President Trump was almost a shoo-in, after the attempted assassination and prior to President Biden stepping aside. But now it's a coin toss, and it's going to be really a tale of two cities come election day. If Kamala Harris wins, we're going to be going in one direction as a country, and if President Trump gets reelected, we'll be going in a different direction. So, stark contrast with what that election is going to deliver. And so I think, I think a lot of people, including myself, are going to sort of take a pause. I'm not very bullish on the market between now and November, particularly as Kamala Harris's poll numbers continue to go up relative to former President Trump.
But Joe, Jim Carville, 1992, it's the economy, stupid. We've moved on from that because having looked at the economic plans of both tickets of Trump and indeed Harris, on either one of those, the CBO data looks blooming awful. You'd hide for cover on the market for a very long time, certainly the bond market as well. So we've moved on from economy stupid to worrying about other issues, haven't we?
I'd like to think so, but I think back to the days of President Clinton, and where President Clinton actually managed to run a surplus, which is quite shocking under a Democratic administration. But I think about the range of outcomes over the short term under Harris administration. Clearly, we're going to see higher taxes across the board. She's going to try to shield the middle class, but taxes are going to go up. I think 2-3 years out, I agree. Under either administration, Democrat or Republican, we are going to see significant problems with the deficit. We've almost reached a point of no return. Some would argue that we have reached a point of no return. But under a Trump administration, I think we're going to have the party will continue for another year or two. And then whether it's President Trump or President Harris, I think we've got some real concerns, which leads me to probably the biggest theme that we're thinking about is the effect of inflation and how that's going to rear its head. I think we're going to have real problems. And I think this idea that we're going to see 3.25% short-term rates again. I just don't buy it.
Joe, let's get into that because it feels if we're talking about a Trump presidency again, we could be talking about the inflation story because of more border controls, more tariffs, more quotas, etc., which we saw first time round. Is that the same case, though, as we talk about a Harris potential win? Is inflation still a likely scenario if that's what we're talking about here?
Yeah, I think it's a problem under either administration. I think as a country, we've made a decision that we're going to onshore a lot of manufacturing. I think we've acknowledged that allowing China to take such a significant position effectively in our economy is not in our national security interest, and all that bodes well for inflation. If one wants to put it in those terms, I think under either administration we're going to be looking at pretty significant inflation as we onshore again. I shouldn't say the only, a big mitigant to that will, of course, be productivity gains. And I think we're all betting and hoping that AI delivers some of those productivity gains that can mitigate those inflationary pressures.
Yes, we are, and particularly as we're talking about 4-day working weeks over here now as well. Joe, thank you very much for joining us. Joe DeGrosso with us, Chairman and CEO of Access Capital.
Dream on, by the way.
Do you know I started my career with 4-day working weeks? One of the big networks I worked with, they had 4-day.
Yeah, I went to these weird educational establishments too, actually, that had 6-day education. I used to have to do Saturdays. Yes. So when I actually started in the workplace at the age of 18, I was like, wow, I only have to work 5 days. Kick on, win.
I've got to say, 4 days, you tend to spend more money. There's one extra day in the weekend to go out and spend.
You sleep more, that's the important thing.
Oh, well. No, that's the aim. Coming up on the show, Tesla reports a much-needed sales boost in its Chinese-made EVs as competition with domestic rival BYD heats up. Plus, as strikes and protests continue to rock Israel, the UK announces it is suspending some of its arms shipments. We'll be crossing out to Dan for the latest. And we'll be getting the house view from Goldman Sachs as it hosts its annual EMEA Credit and Leveraged Finance Conference here in London. The Chief Global Equities Strategist, Peter Oppenheimer, joining us at 8, and Chief Economist Jan Hatzius at 9:30 CET.
CNBC Connect is back in Bangkok, Thailand. Join the world's top entrepreneurs and C-suite executives for an invite-only leadership retreat. On the agenda, powering innovation and growth in Asia. Is AI transforming industries and creating opportunities? And get insights on building sustainable and resilient businesses. Be part of Managing Asia Live. Network and join an interactive brainstorm session. CNBC Connect, powering innovation and growth in Asia on September 4. Register now.
In company news, Cathay Pacific has cancelled dozens of flights as it conducts an inspection of its entire Airbus A350 fleet after an in-flight failure of an engine component. The problems were identified soon after takeoff during a flight from Hong Kong to Zurich on Monday. Shares in British engine supplier Rolls-Royce fell sharply on the news. Ozempic shortages will continue into the final quarter of the year, according to a report published by the European Medicines Agency. Novo Nordisk has warned that shortages of lower strengths of the drug has worsened, while intermittent shortages of all strengths are expected amid increased demand and manufacturing capacity constraints. Brazil's top court has upheld a decision to ban X in the country. Elon Musk defied a court order to name a local legal representative, and a judge also found that the platform failed to prevent hate messages and lies being spread about the country's election. Musk's Starlink has also come under scrutiny and could lose its license. Brazil's telecoms regulator has threatened to sanction the broadband company after it refused to block domestic access to X. The sales of Tesla's China-made EVs grew 3% on the year in August. Deliveries of the automaker's Model 3 and Model Y vehicles made in the country rose 17% from July. However, Chinese rival BYD posted a more than 35% year-on-year jump in sales to a new record high.
Aston Martin chairman Lawrence Stroll has told CNBC customer demand remains strong despite a nearly 36% decline in company's share price this year. So the market's begging to differ. This as the Aston Martin Group launched its most powerful production car ever, a new 124 brake horsepower Vanquish. Well, that's useful, isn't it, for these days? Anyway, a lovely looking car. Aston Martin chairman Lawrence Stroll told CNBC the company is keeping up with changing consumer demands.
We do follow customer demand. We have great demand for our naturally aspirated as well as turbocharged combustion engines. So we are exactly giving the customers what they're asking for. We have a very sports enthusiast customer, a real automotive in every sense of the word. Some people like to say petrol heads. So we have a great following of customers who want a purist sports car, who want the drive, the thrill, the excitement, the smell, the noise. So we are definitely delivering into what customers are asking us for.
Yeah, a lot of that customer demand and needs right now also range around electrification, right? I mean, have you found that the desire and the want for high performance OEMs it has diminished at all because of carbon sensitivity and the need for electrification?
No, we don't find that the decline has happened whatsoever. We have a full portfolio not only of combustion engines, we also have plans of a full portfolio. We're starting to deliver our first plug-in hybrid with the Valhalla, our mid-engine supercar, which we'll be delivering this next year. And following up on that, we'll have two other plug-in hybrids before we go to a full portfolio of electrification vehicles. A couple years back, we showed in our Capital Markets Day our rollout of our EV plan, and that is still very much in place. So we're catering to demands, whether you want to be a purist, whether you want a plug-in hybrid, or whether you want a full EV.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to cnbc.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.